Dave Ramsey says you need to follow the debt snowball if you want to pay down your debt. But wait, I heard the debt avalanche might save me more money. What do I do? Simple. You need to follow the... What's up everybody, I am Jaspreet Singh and welcome to the Minority Mindset. Quick riddle for you. What's a four-letter word that starts with D and ends with T that seems harmless because it's all around you, but if you have too much of it, it will make you feel sick to your stomach? Dust. D-U-S-T. Lucky for you, we're not talking about dust, we're talking about debt, which is actually a whole lot worse than dust. But we're going to be talking about two different debt payoff strategies, the debt avalanche method and the debt snowball method, so you can see which one is better for you with numbers. So make sure you watch this video until the end. But before we get into that, make sure you hit that thumbs up button below, right below the screen, and subscribe to the Minority Mindset YouTube channel. That way you don't miss our new financial education videos every single week, and hit that little notification bell too, otherwise YouTube won't let you know when the new videos are released. Alright, debt snowball, debt avalanche, what's the difference? The debt snowball and the debt avalanche are the two most popular debt payment strategies regardless of how much and how many different types of debt that you have. But the two strategies work very different and they can change how much money you get to keep and how much you have to pay in interest. So let's start by going over how these two debt management strategies work. The debt snowball method says that you take all of your debts and you line them up. So you take your credit card debt, your auto loan debt, your mortgage debt, your student loan debt, you line them all up and then you make the minimum monthly payment for all of them, and then whenever you have some extra cash, you use that to pay off the smallest debt first. Once you pay off the smallest debt, then you take your extra cash and you use it to pay off your second smallest debt, and on and on and on. The debt avalanche starts off the same way. You're gonna line up all your debts and you're gonna make the minimum payment on all of your debts. But when you have extra cash, this is where things get different. With this debt avalanche method, you're gonna take your extra cash and you're gonna use it to pay off the debt with the highest interest rate first and pay that off. And once you pay that off, you're gonna go to the debt with the second highest interest rate, and on and on and on. Okay, let's put some numbers on this so you can see it in action. Let's assume that you have four different debts. You have a $250,000 mortgage on your house with a 4% interest rate that you have to pay a minimum payment of $1,000 a month on. You have a $15,000 student loan balance at 6% interest rate that you have to pay $200 monthly on. You have $10,000 on your car note with a 7% interest rate that you have to pay $100 a month on. And you have $20,000 worth of credit card debt because you really like shopping at a 25% interest rate that you have to pay a minimum of $450 a month on. At this rate, if you just make the minimum payments and you don't add on any more debt, it will take you 44 years to be debt-free. But if you can put some extra money aside every single month and apply it to your loans, you can be debt-free much quicker. So let's assume that you can work hard to save some extra money or earn some extra cash, and you can put aside just an extra $100 to put towards your debt. If you follow the debt snowball method, what you will do is first, you're gonna make this minimum monthly payment for all of your debts, and then you're gonna take this extra $100 and you're gonna first put it all towards your auto loan debt, because your auto loan debt is the smallest balance. So you're gonna take this extra $100 and every month you're gonna put it towards your auto loan debt until this auto loan debt is completely paid off. Once that's paid off, you're gonna take your extra cash and you're gonna put it towards your student loan debt, because this is the next smallest one. Once you pay that off, then your credit card debt, and then finally your mortgage. If you can put just an extra $100 into this debt snowball method and you can stay consistent with it, you will be able to save $151,000 over the course of your loans, and you will be debt-free 23 years sooner. Now, let's compare that to the debt avalanche method. With the debt avalanche, you are going to start the exact same way. You are going to pay down the minimum balance on all of your four debts, and then when you have this extra $100 every single month, you're going to apply it to one debt at a time. But now, you're not going to apply it to your auto loan debt first. You're going to start by applying it towards your credit card debt, because your credit card debt has the highest interest rate. Remember, with the debt avalanche method, you're going to start with the highest interest rate and then move to the lowest interest rate debt. So you're going to take this $100, put it towards your credit card debt, and do this every single month until your credit card debt is completely paid off. Once you pay that off, then you're going to go to the debt with the second highest interest rate, which is this auto loan debt, and then the student loan debt, and then your mortgage debt. If you stay consistent with this debt avalanche method, you will be able to save $171,000 in interest over the course of your loans, and you will be debt-free 24 years faster than if you just made the minimum monthly payments. That means you'll be debt-free faster, and you will save more money in interest if you use the debt avalanche method, because in the debt avalanche, you are going after the highest interest rate debt first. At this point, you're probably thinking, wow, the debt avalanche is definitely better. I'm gonna do that. Whoa, hold on there, cowboy. Let me finish this video first. The debt avalanche method will save you more money, and it will get you out of debt faster if and only if you do one thing. You stick with the plan every single month. The problem with the debt avalanche method is not the math. It's the psychology of sticking with it. For some people, let's face it, it's hard to stick with a plan or a system where you don't see results quickly. With the debt avalanche method, you might have to start off with paying off a much larger debt, which means you might have to wait a lot longer before you eliminate one debt from your life. That's hard for some people. With the debt snowball method, you might not have math on your side, but you do have psychology on your side, because you get these small mental wins because you're gonna be paying off one debt faster and you feel like you're winning. Take that, you debt! Now, before we go over which one's the winner, let's talk about one thing that you can do to speed up this debt payment process even faster. Refinancing. When you're refinancing your loans, you're essentially borrowing money from someone else at a cheaper rate to pay down your debt. This way you have less money to pay in interest. I'll show you what I mean. So if you have a mortgage that's $250,000, or you have $15,000 with the student loan debt, what you can do is you go and borrow money from someone else and you pay off the student debt, and now instead of paying 6% on your student loans, you might only have to pay 4%, or instead of paying 4% on your mortgage, you might only have to pay 3.5%. It depends on how much your interest rate is, but this can help you lower the interest payments that you have to make. Obviously, the interest rates are going to depend on what the market rate is when you go to refinance and what the economy is. But what you need to remember is two things. One, only borrow enough money to pay down your debt. So if you have $250,000 on your mortgage, don't take out $300,000 because you have built up equity. Only take out $250,000 to pay down your debt. And second, just because your monthly payments drop from $1,000 a month to $800 a month or whatever, don't start paying that smaller amount. Continue paying $1,000 a month or whatever your payments are today. This way, you can pay down your debt much faster. If you've ever considered refinancing, or you're looking for someone to help you with the refinancing process, you need to check out our sponsor, Credible. All you have to do is enter in a few pieces of information about your debts and your finances, and then Credible does the work to make the banks fight for you, because they're gonna present you different quotes from banks on the exact same loan or the exact same refinance. This way, you can be sure you're getting the best interest rate possible, and you can be sure you're keeping the most money in your pocket. Their service is completely free to use, and it doesn't cost you anything to get a free quote. So if you want to save money on your student loans or your mortgage or whatever other debt you have, you can see how much money you can potentially save using the link in the description below. Minority Mindset is a partner with Credible, so if you use them, we will get compensated, but there's no additional cost to you. They are free to use, so you literally have nothing to lose, and you have a lot of interest you can save. So now, time for the big question. Which one is better, the debt snowball or the debt avalanche? The answer is the one you will stick with. The debt avalanche will save you more money, but it requires you to be more disciplined and stick with something even if you don't feel like you're winning. That's hard for some people. The debt snowball gives you those mental wins, so you need to know yourself. At the end of the day, here's what you need to know. Consumer debt sucks. When you go and finance your brand new car, not only do you have to pay $40,000 to your dealer for a car that you'll only be able to sell for $20,000, but you also have to pay your bank $5,000 or $10,000 because you don't have the money to afford your car in the first place. You need to first break the habit of buying things that you can't afford, and then you need to get out of this consumer debt as fast as possible. This way you have more money to buy things that make you money. That's exactly what wealthy people do. Now, instead of using all of your money just to buy things that lose you money like a new car, you're gonna use your money to buy things that make you money, like maybe shares in a car company. Now you're shifting your mindset from the consumer mindset to the investor mindset. And to help you out with this, we even have an ebook on money management and investing that you can read for free when you sign up for our financial education emails. You can do that by clicking the link up here or by clicking the link in the description below. Thank you for watching. If you enjoyed the video, share it with one friend. That way we can help spread the word. And if you want to learn more about how you can pay down your student loan faster with some tips and tricks, I already made a video on how you can do that. And you can watch this video on YouTube by clicking this button right here. Thank you for watching. And as always, keep hustling.